All right, investors have long been casting doubt on the benefits of the traditional 60-40 portfolio model. The naysayers getting louder in recent months as central bank policy tightens and bonds lose value. Now, a new report out of MSCI claims to have found the secret to a macro-resilient portfolio. Yahoo Finance's Alexandra Semenova has more on this. So, Alexandra, I'm guessing it's what, 25% crypto, 25% risky bonds, right?
Emphasis on the crypto,
okay,
obviously.
There we go.
Guys, for years we've heard strategists speak to the demise of the 60-40 combination of stocks and bonds, with that chatter getting even louder this year as that portfolio mix is on pace for its worst performance in a century. But strategists at MSCI and GIC, which is the government of Singapore's sovereign wealth fund, see this as an opportunity for a new and improved asset allocation framework. What they propose instead is a long-term portfolio composition that better integrates macro risk when making investment decisions. Essentially, rather than sticking to this outdated notion that stocks are associated with growth and bonds are just a hedge against volatility, they instead say that investors should model individual asset classes against 5 macro risks they expect will dominate the investment landscape in the coming decade. Those are shocks to demand, supply, trend growth, central bank policy, and long-term real rates. And to do so, this involves a shift away from what they deemed short-sighted, outdated, backward-looking measurements of risk. So incorporating these measurements of volatility will help position long-term investors. They also recommend adding private assets into investor portfolios, but doing so in a way that is on equal footing with public equities rather than just having a small allocation to this. And again, this happens once you properly measure that risk. And their view also is that we're in this new regime where we're seeing secular changes to rates, to central bank perceptions, to supply chains. And that view is consistent with what we've been hearing. We heard that first from BlackRock. So investors really have to adapt to this changing landscape and move away from the traditional way of doing things.
Separately here, you're also following news that Instacart has postponed its long-awaited IPO. What do we know about this?
Indeed, this Instacart game of back and forth is kind of representative of this changing landscape where we're no longer in a period of growth and we might not get back to it for a while. We heard them file for an IPO earlier this year, hoping to roll it out this year, but instead they postponed it to 2023. This is really interesting. It's also going to be interesting to see how employees receive that news, employees who have been anticipating this. This was highly anticipated across Wall Street, and it's not surprising at all that they've delayed it given the IPO landscape that we've seen. IPOs are down a whopping 94.1% this year. Only 65 companies have gone public in 2022. So obviously not a good time for Instacart.
I will say this. It's okay to shop for your own groceries, to get in the car and just go shopping at the grocery store. You don't
do like me and just walk to the grocery store.
Just walk to the grocery
store. People
store.
are ordering everything. No one leaves their house anymore.
All right, fair enough. Alexandra Semenova, good to see you. Good analysis.